Okay, let's get the pulse of M&A activity. Globally, it's been huge, and locally, it's picking up as well.
Yeah, Intralinks is out with a deal flow indicator report. It's tracking the volume of transactions. Phil Whitchelo from the company is now joined by our own Nigel Freitas, live from the ASX. Nigel.
Brooke and Carson, thank you. Philip, the deal flow indicator report, what does it actually track and how does it work?
Yes, thank you, Nigel. Intralinks is the largest global provider of virtual data rooms to M&A transactions, and we get involved in the very early stages of M&A deals. So the deal flow indicator report actually tracks the number of data rooms that Intralinks is opening, both in the preparation stage and prior to due diligence stage of M&A transactions. And we also track the ones that competitors are opening as well, because we basically see all the proposals for deals in the market. So the DFI, or deal flow indicator report, actually tracks the, if you like, the volume of those data rooms being open every single quarter.
So every time a company undertakes some M&A activity, they tend to open one of these data rooms, and you track the volume of that and not the value.
That's correct, yes. We track the number of data rooms which are being opened. Actually, volume is actually more important when you're tracking activity than value, because approximately 40% of M&A deals have no announced transaction value. So if you only focus on the value of deals, you're missing out 40% of the market. So we actually look at both.
Now we know how it works. At a global level, what are the numbers telling you in terms of M&A activity?
Yeah, I mean, it's very interesting. The Q1 deal flow indicator report indicates to us that M&A activity is returning quite strongly to the market. On a global basis, we're seeing a 16% year-over-year increase in those early stage M&A deals being launched. In the APAC region, we're seeing an even larger increase, 18% on a year-on-year basis, and about 10% if you look at quarter-on-quarter results. So that indicates to us that there's going to be, a large uptick in activity about 6 months into the future, because the deal flow indicator report tracks those deals which are opening now, their data rooms, and those deals will be announced in approximately 6 months' time. So it's a really good leading indicator or predictive indicator of future announced M&A activity.
I did notice, though, that the numbers are down quarter on quarter, although they are up year on year. How concerned should we be that they have dropped from the last quarter?
We shouldn't be too concerned, because quarterly numbers have seasonal effects in them. So we normally see a decline in activity in Q1 compared to Q4. It's very important to try to focus on year-on-year numbers so you don't include those seasonal type of effects.
What kind of sectors are you seeing M&A activity increase here in APAC?
In APAC, we're seeing an increase in activity in a number of sectors. One is energy and power, consumer products and services, healthcare, and also telecoms, media and technology.
And that's different to resources, where a lot of this has actually been concentrated in the past.
Yes, I mean, absolutely, particularly for Australia. I mean, your M&A scene has been dominated very much by the metals and mining sector in the last couple of years, particularly, obviously, from inbound investment from China. And actually, in Q1 of this year, we've seen quite a significant decrease in metals and mining type deals, also a significant decrease in activity inbound from China. But that's not to say you should be worried about that, because other sectors have taken up the slack. So we're seeing, if you like, a sector rotation away from metals and mining to other sectors such as E&P. In fact, the 4 largest deals announced of this quarter were in the energy and power sector, but also in sectors such as real estate, consumer products and industrials. So I think there's not much to be worried about in terms of the general level of M&A activity.
Now, we have seen inbound M&A from China drop off, especially in that resources space. What about outbound M&A here from Australia back into Asia?
Yes, I mean, good question. A very interesting thing has been happening. This quarter, we've seen a big jump in outbound M&A activity from Australian companies. So Australian companies becoming much more acquisitive internationally, particularly going into countries such as the United States and also other Asian countries such as Singapore. We've seen probably a 10 to 20% increase in the value of outbound M&A deals from Australia. So again, that's helping to, if you like, take up the slack from the sort of downturn from the inbound M&A from China into metals and mining.
In terms of volumes overall, though, they seem to have been relatively constant for some time, but we are seeing bigger deals happen. What does that tell us about the market?
Yes, absolutely. So, in terms of volumes have been declining over the last couple of years, but value has been going up or has been remaining relatively constant. So what that means is average deal values are going up, and we're seeing the return of what we call the mega deals. Now, normally that indicates to us the start of another sort of uptick phase in the M&A cycle. When you see lots and lots of big deals around, that normally will pull the rest of the market up with it. So we think that's also a positive sign for M&A for 2014.
And Philip, what do you think is driving this resurgent activity? Can we make some pointers here or get some indicators that generally things economically are picking up globally?
Absolutely. So there's a couple of factors driving this increase in activity, we believe. One is the continued sort of low interest rate environment. Financing is pretty easy to come by. Also, economic output is increasing in most countries around the world. The world's economy is, if you like, recovering and gathering pace. And also, we think consumer confidence and also company confidence is returning. There's a lot of corporate cash sitting on balance sheets, which companies realize they have to put to work. They're not earning a return on it. Interest rates very low. They're not going to get a cash return on that money. They need to put it to work somehow into productive assets and services and try and sell those to consumers. So we think those are all positive factors for M&A activity.
And just lastly, we have seen some of the banks express concern about the level of M&A activity here in Australia and close down some of their M&A divisions and focus more broadly on Asia. Do you think that's going to be the future, that M&A activity domestically within Australia will continue to be subdued, but it will be more of an Asian story?
Well, actually, I think domestic M&A has actually been increasing in this quarter compared to last quarter. And I think, yes, there have been some bank closures down of M&A departments, but I think broadly Australia will still be a hub for M&A activity in the region, definitely.
Okay, Philip, thanks for your time. And Brooke and Carson, I'll swing things back to you.